Welcome to my video. I'll trust you'll find it helpful and informative. Please remember to like and subscribe. Thank you.
And I just want to say to you, I can give you a letter if you want it. This question is in the exam, definitely. But it is marks for nothing. It is the simplest module in the entire book, if you ignore the book and focus on the slides, that is. So let's have a look at how managing working capital works. Okay. First, we have to look at working capital concepts, and none of these concepts are concepts that are new for you because you have dealt with all these concepts in bookkeeping already. And so when we are talking about working capital, we are really just talking about the difference between our current assets and our current liabilities. Okay. And so therefore we must know what our current assets are and what our current liabilities are. Now you know what your current assets are. It's obviously inventory, debtors, and different sources of cash, whether that's your cash float or whether it is your bank account or whether it is your petty cash or whether it is money that you're keeping in a fund account. It doesn't matter. That is your cash. And what we have with working capital and current assets is that we have a cycle. So I've tried to indicate the cycle for you there. So we have inventory. We sell the inventory to debtors. The debtors pay us in cash. We use the cash to buy new inventory, and so on and so on. So that's really how the working capital cycle works. And then our current liabilities are simply debts that are due within the year. If the debt is not due within the year, then it's a long-term liability and it's not current. And then, of course, our net working capital will then be our current assets minus our current liabilities. And really, that will show how liquid the company is and how quickly we can pay our debts and things like that. Now, next concept that I have to bring in here is working capital ratio, where we simply take our current assets that we have now calculated and we divide it by our current liabilities. And I then made a claim there. I said 2 to 1 is ideal. It's ideal if your current assets are twice as much as your current liabilities. Please understand that that is not true in all cases. It really depends on the industry in which you are working. There are some industries where we will never get to a 2 to 1 ratio. Okay, in which case 1.5 to 1 might be ideal. Others where we'll be lucky if we get 1.2 to 1, and it might be ideal if we're in an environment where our stock is turned over very quickly. Okay, and then we have the asset test, where we take our current assets, we subtract our inventory, and we divide that with our current liabilities. And then 1 to 1 is ideal because it means we are still in a position to pay our debts as they fall due, and we don't have to sell inventory first. We don't have to wait for sales. In the current economic environment that we are living in, that is a very tough ideal to achieve, but yes, we're trying to get there. And then there are several factors that will influence our working capital. For instance, what is our ratio of cash sales to credit sales? Okay. Same, what is our ratio of cash purchases to credit purchases? Think about it in this way. For instance, say you can buy your stock on credit from a creditor and they give you 3 months to pay. Then you take that stock and you sell it to your debtors and you give them 1 month to pay. It means that you are always going to have the money to pay the creditor because the money comes in before you have to pay it. But of course, if it's the other way around, then it becomes a problem. So we sometimes will give the companies terms, but our book supplier edge wants money on, well, not even on delivery, on placing the order. And so in their case, I'm sitting with the books and I have to order them way before I've received the payment in some cases. So there's a risk there. And so as you have cash sales and credit sales, you also now have cash sales and credit purchases, and credit sales versus cash purchases. That's exactly what I explained to you now. Then we have the debtors collection period and our creditors settlement period. And I've indicated that already. Our lead times, obviously, if you are selling something that is big and you are selling it in the bundos, it might take a long time for you to get there. And then there's another factor that will influence your working capital. Stock turnover, discounts, credit losses, and debtors factoring. All of these are factors that will influence your working capital. Okay, but that's just a little bit of theory. Let's move on to the next slide. Slide 4 talks about our nominal interest rates versus effective interest rate. This is the first type of question that you can expect in the tests and all the exams. And it works like this. It says, assume 3 options. Bank A offers 15% interest compound daily. Bank B offers you 15%, assume this is a loan, compounded quarterly, and Bank C gives you a 16% compounded annually. Now let's see what this means, okay? So if we are going to calculate our effective interest rate or our effective annual rate, that's why you have an A there, for Bank A, we have to take that 15%, okay, that we had. Now remember, it's always 1 point. Now instead of saying 1 point, here I said 1 plus the decimal. It's the same thing. 1 point the decimal and 1 plus the decimal will bring you to exactly the same thing. So here we take that interest rate, that is 15% annually in the case of Bank A, and we divide it by 365 because it is compounded daily. But then we also have to express the power as the same power with which we just divide, because it is compounded daily. So every day we are paying interest on both the capital amount and whatever it was the previous day. So we take the 15% or the 0.15, we divide it by 365, and then we take that full thing that is now 1 point something, and we raise it to the power of 365. Now, for most of you on the calculators that you are using, that is the y to the x or the x to the y sign. I've showed you before that when we do it in Excel, we use the little exponent sign, which is normally Shift 6 key. Okay, so if we do that, we say we get to a total of 0.1618. Remember, we have to subtract 1 again because we are looking at the difference. So we're dealing with a 1 point to the power to get a total, but we must remove the current thing because we only want to look at the interest, okay? And so then we change that decimal into a percentage, and when we do that, we see that the effective annual rate for Bank A is 16.18. So initially it looked a full percent less than Bank C, but because it is compounded daily, we are actually paying a little bit more interest. In the case of Bank B, it says that it is compounded quarterly. Now that means a quarter is a fourth, just another way to say a quarter. So it's being compounded 4 times a year. So in this case, we take the 0.15, and I did that on purpose. So just to show to you that whether we're saying 0.15 or whether we are saying 0.15, still the same thing. Same if you just had 15%. So you now say 1 plus, in brackets, 0.15 divided by 4 because it is compounded quarterly, and we raise it to the same power minus 1. That is how you're going to key it into your calculator. You get 0.1587 or 15.87%. And in the case of Bank C, it's already telling us that it's compounded annually, so we don't have to do any calculation there. We just keep the 16%. Okay, and now we can see that Bank A, the interest rate is really, the effective interest rate is 16.18 per year. In the case of Bank B, it's 15.87, and in the case of Bank C, it's 16%. Now, the higher the effective annual rate is, the better it is for investors. You want a high rate if you are going to invest. But if you are going to borrow, then you want a low effective annual rate because that is better for lenders. Okay, but now I say to you, also consider the following cost before making a decision, because this now looks pretty obvious. I'm going to take out a loan and I'm going to choose Bank B because the effective annual rate is the lowest. But the truth is there are always fees and or points or things that you must read carefully. That is in the fine print. So is there a loan processing fee? Yes or no? And if there is, what is that loan processing fee? Is there an underwriting fee? If yes or no, and what is that underwriting fee? Are there any prepaid fees? Is there origination points and how do they charge you? So often with the way the point system works is there will be some criteria and you will fill in a form, and then the higher or the lower you score, it will affect your fees that you are paying. So if you are less of a risk for the bank, then they might give you a discount on the fees, or they might even give you a discount on your rates. Okay, is there application fees, and do they demand that you take out credit life insurance? Because some of the banks, they will say to you, you know what, we'll give you the loan at this fantastic rate, but we now have to reduce our risk, so please take out credit life insurance on the loan, and then in the end, you might as well go for a loan with a higher interest rate that doesn't demand that you take out credit life insurance. Now, there's no way we can test all of this really in a test or an exam. We are only saying to you that you must be able to compare rates like we've did at the beginning of the slide, but be aware that there's always these other costs that you might have to deal with as well. Okay, now let's talk about the schedule of expected receipts. So this is really the second type of question that can come up in this model. So it's, once again, it's a long model. You can go and read through it, but there's only 3 questions that will appear in the model. Okay, the one is this one: calculate the effective interest rate. The second one is to do with a schedule of receipts. Now, putting it on a slide was actually quite challenging, but I was able to do it. So it says draft a schedule of expected receipts for months 3 to 5. Now, in a test or an exam, they're never going to say to you months 3 to 5. They are going to say March to May or something like that. Okay, and this is what they tell you. They say this is really how your debtors collection work. 50% of sales is in cash. Okay, 25% of your debtors will pay you in 30 days. 20% will pay you in 60 days. Those are your good customers for which you give good terms. And the truth is that 5% of your debtors will never pay you. Bad news. You just get used to the fact that you're going to write that off as bad debt. But now, because of that, you need to know the sales for the prior 5 months. Because in this month 3, you are now going to get in 3 types of cash. The cash sales made in month 3, okay? The people who are paying you after 30 days for sales made in month 2, and people paying you after 60 days for sales made in month 1. So let's have a look at it. If we look at month 3, okay, there is month 1, 161. Month 2, sales of 170. Month 3, sales of 173 and 74 rather. And then in month 5, sales of 185. And in the last month, sales of 194. Now look carefully what is happening here. In month 3, we take the sales of month 3, which is 174,000, and we multiply it with 50%, because 50% of our sales is going to be in cash. Okay, so that's the first part of the money that's coming in month 3. Then we take the sales from the previous month, which was 170,000, and we multiply that with 25%, because we know that 25% of our debtors is going to pay us in 30 days. Then we go back 2 months where we had sales of 161,000, and we multiply that with 20%, because we know that 20% of debtors is taking 2 months to pay us. Right? And that is then the 32,200 that you have in that first column. And then we add them up to see that in month 3, we are going to receive cash payments to the tune of 161,000 rand 700. Okay. What about month 4? Well, in month 4, we make sales of 185,000. 50% of that is cash. So we take the 185,000, we multiply it with 50, and we get 92,500. We go back to the sales of the previous month, month 3, where we sold 174,000. We take the 174,000, we multiply it with 25%, or you could have just divided by 4, and you get 43,500. Okay. What about the sales 2 months prior to that? Because remember, 20% of the people are paying in 60 days. Well, you take that sales, the 170,000, you multiply it with 20% or divide by 5, whichever way you want to do it. You get to 34,000, and when you add that up, you see that your total cash inflow for month 4 is going to be 170,000. If you look at month 5, then you say, okay, my cash sales in month 5 is 194,000. 50% of that is in cash, so it's 97,000. In the previous month, it was 185. Let's multiply that with 25% or divide it by 4 and get to 46,250. And then go 2 months back and we divide that by 5 or multiply it by 20%, and we see that that is 34,800. And once again, we simply add all of them up. Now you will ask me, what about the 5%? Well, nothing about the 5% that you lose. You're not going to calculate it, because this is just a schedule of receipts. You're never going to receive it, so you're never going to put it on the schedule. You know that you are going to lose it. Okay. Now, when you guys do financial statements, you will do a provision for bad debt. But we're not there yet. You're not doing that in bookkeeping yet, and you're definitely not doing that in business management yet. But there is a way in accounting to account for this bad debts, but it is not in your schedule of expected receipts. Okay. Let's have a look at the last slide. And this is the third thing in this module that you are definitely getting in test or exams. So what they give you is they give you a number of accounts, in this case, creditors, mortgage loan, land and buildings, inventory, debtors, accrued income, accrued expenses, overdraft, bank, VAT output, VAT input, and income received in advance. And you must say, is this a current asset, or is it a current liability, or is it something else? If it is something else, you don't worry about it. You are only going to say, is it a current asset or is it a current liability? So here you have creditors 130,000. Okay. Now you have to pay those creditors, so it is a current liability. You have your mortgage loan. Okay. Now, if they give it to you like that and they don't give you any way of calculating, they don't say to you that 100,000 is still due in the year, then you can ignore it. If they did say to you that 50,000 or 100,000 is due in the year, then it would be a current liability. But in this case, we're just saying mortgage loan, so you can ignore mortgage loan because it is a non-current liability. Same with your land and buildings. Okay. Wonderful that you owe land and buildings to the value of 900,000, but it's not like you can quickly sell your land and buildings and use that money. Okay. It's a long-term thing. So your land and buildings is a non-current asset. So you're going to ignore it. You are not going to record it here. Inventory is a current asset, so we're going to put it under current assets. Debtors is a current asset, so we are going to put it under current assets. Then we have something here that is accrued income. Now, accrued income means that you have done the work. Often your accrued income will be a service income, but you are still waiting for the money, and therefore it is a current asset. But the same applies for accrued expenses. These are expenses that are due. It's not the necessary creditor expenses. This can be SARS expenses. It can be any expense that you can think of. And it can be a loan from a director that you still need to pay back, and that date is coming up in the year. That accrued expense therefore becomes a current liability. Your overdraft is always a current liability. Okay. Money in the bank. This is now positive because we distinguished between the overdraft and the positive value of the money in the bank. The money in the bank is a current asset. Okay. Then your VAT output. Remember, output VAT is when you sell something, you collect some of the money on behalf of SARS. You have to pay that money within 2 months to SARS, so it is a current liability. Your VAT input is the amount that you are really going to subtract from that. So you could just have a VAT control account and then it would be the difference between the two. But in this case, I'm giving you VAT output as well as VAT input. So VAT input is a current asset. And then we have something here called income received in advance. Maybe there is somebody that is leasing part of the property from you, and they say, oh, I'm just going to give you some of the money in advance. You should record that as a current liability, because just now something goes wrong. The guy suffers an unexpected death because he is hit by a bus, and his wife comes to you and she says, I now need that 1.5 for the funeral. Then you will have to give it to her. Therefore, it is a current liability. That was the worst and the crudest example I could think of on the spot. My apologies for anybody who has ever been hit by a bus or lost a family member that was hit by a bus, but I think you understand how it works. So this is then what we do. We total the current assets and the current liabilities, and we see here that our current assets is 163,500 and our current liabilities is slightly less, 156,600, and then we can calculate our net working capital by simply subtracting the current liabilities from the current assets, and we do have a bit of money that we can use here, and in this case it is 5,900 rand.
Thank you for watching this video to the end. If you found it valuable, please subscribe and like. Thank you.